The order came down without warning. Beijing told its biggest tech giants, ByteDance, Alibaba, Tencent, to stop buying NVIDIA's H20 chips. Not a suggestion, not a guideline, a directive, a move that threw U.S. chip makers into turmoil and forced Wall Street to face a reality it kept ignoring. At the exact moment Washington claimed leverage by taxing American chip sales into China, Beijing flipped the game by telling its companies to cancel the orders altogether. Why does this matter? Because China is the world's largest buyer of advanced semiconductors. According to Bloomberg, sales to China accounted for over $17 billion of NVIDIA's revenue last fiscal year, more than 13% of its total. Strip that away, and suddenly the American champion of artificial intelligence looks vulnerable in ways analysts didn't price in. The contradiction is immediate. The Trump administration framed its deal with NVIDIA and AMD as a national security win. Washington would allow limited chip sales to China, but skim 15% of the revenue straight into the U.S. Treasury. A tax disguised as patriotism. But the moment the policy hit, China struck back, signaling to its domestic tech firms that every dollar they spent on U.S. chips was a dollar subsidizing their rival's government. Beijing reframed the purchase itself as unpatriotic. Markets reacted fast. Reuters reported that shares in China's Semiconductor Manufacturing International Corporation jumped 5% in a single session after the directive on bets that demand would shift toward domestic alternatives. SMIC, long dismissed as lagging behind, suddenly looked like the safer bet. Meanwhile, NVIDIA slipped, AMD fell, and investors realized that America's clever revenue share was only clever until China decided not to play. The escalation doesn't stop there. Beijing's regulators summoned executives behind closed doors and asked them a direct question. Why are you ordering NVIDIA's H20 instead of buying from Huawei? This wasn't about efficiency or performance. It was about legitimacy, and the question alone was enough to spook buyers. The Financial Times confirmed that some Chinese firms immediately began downsizing orders, not waiting for formal bans. In a political system where guidance often carries the weight of law, the safest strategy was compliance. Consider the downstream shockwaves. Bloomberg reported that United States chip equipment makers, Applied Materials, Lam Research, and KLA now face billions in orders at risk because Chinese fabs are recalibrating procurement. If NVIDIA and AMD lose buyers, upstream suppliers lose, too, shrinking America's ecosystem from top to bottom. Meanwhile, China's government announced a $47 billion semiconductor fund expansion in July, its third since 2014, aimed directly at financing domestic AI chip projects. That figure isn't abstract. It's more than what Washington has dispersed so far under the CHIPS Act. And here's the viral punch. Analysts at Goldman Sachs now estimate that if China fully restricts NVIDIA's H20, United States GDP growth could fall by 0.3 percentage points in 2025, simply from the loss of semiconductor exports. In a fragile economy where July's deficit already hit $291 billion, that's not trivial, it's systemic. The result is an inversion no strategist wanted to admit. The more Washington leans on tariffs and revenue schemes, the faster Beijing accelerates its own independence. And with every canceled order, United States firms don't just lose revenue, they lose time. In technology, time is the only resource you can't buy back. NVIDIA pushed back in public. The H20, the company insisted, was not a military product, not for government infrastructure. Executives emphasized the chip contained no backdoors, no hidden kill switches, none of the national security risks implied by Chinese state media. But that argument missed a larger point. The evidence shows Beijing isn't simply worried about security. It's leveraging suspicion as a tool to star United States suppliers and accelerate its own semiconductor independence. Here comes the first data shock. In July 2025, China's imports overall rose by just over 4%, while exports to the United States dropped by double digits. According to official customs figures, the shift is unmistakable. Beijing is reducing dependence on the American market while deepening ties elsewhere. Sales to Southeast Asia grew 13%, to Africa 21%, to Europe nearly 7%. What Trump called decoupling looks less like United States control and more like China's rebalancing. This is where the contradiction spikes. For months into the tariff war, Scott Bessent, long one of Trump's economic defenders, was forced to admit that U.S. importers pay the tariffs, not Chinese exporters. The very claim used to sell the public was exposed as spin. Yet Biden still told investors that exporters would eat the costs to preserve market share. That hypothesis collapses under scrutiny. Reuters data shows over 446 U.S. firms filed for bankruptcy this year, the highest in 15 years, surpassing even the pandemic peak. No exporter is eating 30% losses for the privilege of shipping to America. They're walking away. Now the new question emerges. If the tariff model is collapsing, if Beijing can redirect exports, and if China can weaponize consumer demand against U.S. chip makers, then what leverage is Washington really left with? Let's test this with numbers. The U.S. budget deficit in July alone hit $291 billion. Treasury data confirms despite $27 billion in customs duties, outlays grew 10%, dwarfing the 2% growth in receipts. Tariffs are no longer reducing deficits. They're financing a tiny fraction of ballooning spending. This makes the 15% chip tax look less like a strategy and more like a desperate patch on a widening hole. And yet, the rhetoric continues. Trump insists reshoring will succeed, bringing back factories, reducing risk and independence on China. But here's the contradiction. To reshore effectively, the U.S. needs the very critical inputs that China dominates: rare earths, critical metals, and the intermediate goods that go into EVs, semiconductors, and even defense equipment. 70% of rare earth imports to the U.S. still come from China. That's not a statistic to brush aside. It's a structural dependence. This sets up the next escalation. Imagine trying to build an AI-ready defense sector while Beijing controls the rare earths to manufacture guidance systems and advanced optics. Even if Washington finds alternative suppliers, Malaysia, Japan, perhaps even Russia, the cost will rise and supply will shrink. China doesn't have to embargo. It just has to raise friction, and the strategy unravels. Now, focus back on chips. Before Trump's April restrictions, Chinese demand for advanced GPUs was projected at 5 million units, worth more than $20 billion in sales, according to Bloomberg Intelligence. Pulling that demand back creates a vacuum. Domestic firms like Huawei step in. Reuters notes that Huawei's Ascend AI chips are already being promoted as the patriotic alternative. And as China directs billions in subsidies to its own fabs, every lost sale for NVIDIA doubles as fuel for its rivals. The irony sharpens here. Tariffs intended to slow Beijing's rise are accelerating it. U.S. firms like NVIDIA are forced to raise prices at home to offset lost Chinese revenue, making their products less competitive globally, while China uses the void to scale production, lower costs, and gain share in emerging markets. Another data drop hits China's production of industrial robots surged by 52% in April to more than 71,000 units in a single month, official statistics show. Pair that with surging AI adoption in Chinese manufacturing, and the logic is clear. While Washington taxes U.S. firms, Beijing is automating faster, slashing costs, and creating new demand for domestic AI chips. At this point, the contradiction is impossible to ignore. Trump and Bessent claim tariffs are rebuilding U.S. strength. Yet, the measurable effects are bankruptcies at home, deficits widening, and foreign markets tilting further toward Beijing. Meanwhile, China leverages consumer power, regulatory pressure, and industrial policy to reshape the playing field. You must confront the new question again. What happens to U.S. technological leadership if its biggest firms are starved of the world's largest growth market? NVIDIA and AMD need demand not because they can't survive without it. They can, but because innovation is fueled by volume. Research and development at the cutting edge requires billions in recurring revenue. Lose that, and China's relative pace accelerates. By the final act, the twist becomes clear. Washington believed taxing chip sales would prove U.S. dominance. Instead, it exposed dependence. By trying to control the flow of technology, it reminded Beijing how critical its own market leverage really is. And Beijing responded not with concession, but with cancellation. The irony is brutal. Every policy designed to punish China has left U.S. firms cornered, deficits ballooning, and global supply chains rerouting around America. And so we end not with resolution, but with reversal. The world's second largest economy tried to dictate terms, and the world's largest rewrote them. Tariffs became subsidies for Beijing's rise. Restrictions became incentives to build at home. And a single directive, stop buying U.S. chips, did more damage to Washington's leverage than months of trade war threats. The contradiction stands